Marc Geredes here at Sunday, back again after a few weeks hiatus with a new installment of Market Minute. My wife and I were actually out helping our daughter, who actually just bought her first house. Unfortunately, she had to go to Colorado to do it, but that's another story for maybe next week. Anyway, back on March 24th, I talked about this concept of real hourly earnings, which simply defined our person's wages after adjusting for inflation. I use the example of where if you're paid $20 per hour, your earnings are effectively higher than that in a period of low inflation. So what it means is you can buy more things versus a period of high inflation where you can actually buy less things with those same dollars, if that makes any sense. So this week, I wanted to give you a visual of wage growth versus the rate of inflation to help provide some context as to why the Federal Reserve keeps interest rates higher for longer, or their stance of keeping interest rates higher for longer is understandable. But it's actually creating an underlying problem that I want everybody to be aware of. So let's go take a look. Wage growth versus the rate of inflation, or the growth of the rate of inflation from the period of time of roughly March of 2020 through March of 2024. So basically last month. And I thought I'd start by giving a little context of what was happening prior to March of 2020, and roughly from 2012 through 2021, wage growth was exceeding the rate of inflation, increase of rate of inflation. So you have this period of time, which is really good, where the growth in wages was exceeding the growth of in the rate of inflation. And so basically people could afford the goods that they were buying and maybe actually have a little money left over to pay down debt or put in the bank or whatever. And then you can see what happened in April of 2021. The rate of inflation actually surpasses the wage growth for the first time in many, many years. And this obviously was a bad thing. And you can see that line go up all the way until March of 2022, which is where the peak of that black line is, which is when actually the Federal Reserve started raising interest rates, because inflation was, essentially out of control. It was like 7.5% or something like that, or 8%, I think, at the time. Good news is, as they raised interest rates rapidly, it had the desired effect. And so you can see that black line start to go back down again, eventually crossing back over the blue line in February of 2023, where once again, wages exceeded the increase in your wages, or wage growth exceeded the rate of inflation, the cost of the increase in the cost of goods. Easy for me to say. So again, a period of good time, really from February of 2023 and until now. And what I mean by that until now is that you can see the blue line start to trail off again. So that means wages are actually falling again. The growth in wages is actually falling again, flat to falling again at the same time that inflation has been bouncing around there from those lows and actually starting to turn back up again. This is the thing that has the Federal Reserve concerned and why they've taken the stance of higher for longer. Here's the problem. Credit card delinquency. We talked about the growth in credit card debt a few weeks ago. Credit card delinquency is actually starting to become a big problem here. And I'm going to again take you off of the chart to the left here and talk about what was happening prior to 2007, just to give you context. So from a historical average, delinquencies are somewhere around 3 to 3.5%. Credit card delinquencies average around 3 to 3.5%. That's, I guess, considered normal. And then you can see during the financial crisis of 2008, 2009, credit card delinquencies actually peaked at 4.85%. So pretty bad, 5% default rates or delinquency rates on credit cards, delinquency default rates. But then that is followed by an incredible period of time from 2008 to 2009, really through COVID, where credit card delinquencies dropped to an all-time low of 1.53%. So basically half of what has been the historical average. And, it's no surprise. Everybody was locked up and couldn't spend. So they were saving money, paying down credit card debt. Everything was good. But what's happened since then? You can see that line starting to go up and to the right, which is not good in this context. So in Q4 of 2023, delinquencies were at 3.10%. So from a historical standpoint, at 3 to 3.5%, that's in the range. But the thing is, we haven't seen that level of delinquency since Q1 of 2012. So basically almost 12 full years it's taken to get us back to the delinquencies that we saw back then. As I said, is it a proverbial canary in the coal mine? Perhaps not. It's certainly possible that wage growth will not fall any further, and the Federal Reserve will be successful in bringing down the rate of inflation to its 2% target, but only time will tell. I got to tell you, I don't like it. Anyway, that's all I have for this week. Next week, we'll spend a minute or two diving deeper into affordability of real estate with a focus here in California and the story about my daughter buying her house in Denver. Anyway, until then, have a great week, everybody. See you next week. Take care.